In this masterclass, we're going to take a look at trading terms. So what do we mean by trading terms? What trading terms in particular are we looking at? We're going to start off with the basics in here, and we're going to start by looking at buy and sell. What does it mean to buy? What does it mean to sell? Anything, any trading, when we're trading, when we're investing, when we're looking at different asset classes, what is buying, what is selling? Seems quite obvious, but we'll take a little bit of a look at that. We're going to look at what it means to be long and to be short. Okay, so slightly different to buying and selling, but we're going to be looking at long and short. We're going to be looking at bull and bear, or bullish and bearish. And finally, we're going to be looking at risk on and risk off. So what do these terms mean? Well, let's look at buy and sell. To buy, it seems fairly simple. When we buy, it means we take ownership of whatever it is we're buying. So if we buy a stock, that means we're taking ownership and buying that stock, owning that stock. And when we sell a stock, usually it means we've already bought the stock and we're selling it, but not always. We can sell what's called selling short, and we're going to come to that shortly. So buying is to take ownership. So in this case here, we're looking at Amcor, and the market, you see, has had a significant sell-off in here. And as the market has sold off, what we're seeing is a potential to buy that market as it dips lower on the sell-off. So maybe you're looking to buy on the dip in here. Let's look at sell. So selling is when we maybe already bought the product, we've already bought the asset. So we maybe bought, I don't know, maybe copper. Maybe it's Amcor again in here. We're looking at Amcor, and then maybe now what we're doing is we bought Amcor as the market moves higher, and now we're selling to get out of that position. So we're liquidating the position. We're going from being long the position, which we're going to come to shortly, but we're going to have bought the position initially, and then we've sold it. Or we might actually sell to go short and actually be short not own this product, actually be short, looking for the Amcor to go lower in price. We're going to come to that shortly. But buying and selling, we could either buy to open a position to go long, or we could buy to cover maybe a short that we already have when we've already previously sold. And we sell to either cover a long position, so having already bought, or we sell to go short. Okay, so we're going to cover those now when we go to looking to buying to go long. So we buy to go long is buying to take ownership, and then if we sell to go short, it means we sell, and then we're looking for the market to go south, to sell off in here and profit from the market moving lower. So there's sell to go short and sell to cover a long. Or there's going long to be long, or there could be buying to actually cover a short position. Okay, so there's slightly different nuances to buying to be long, buying to cover a short. Okay, let's look at the next set of terms in here: bull or bullish, and bear and bearish. So bullish is expecting the market to go up in price. So here we see the rally in Amcor from May. This is looking at 2018, and that is a bullish move. So for the market to be bullish, it means the market is going up. And if we are bullish or we are bulls, it means that we're looking to profit from the market going up in price. If we take a look at bear and bearish, it's the opposite of this. So from late December of 2017 through to April, May in here, we've seen Amcor go lower in price. And through that period, if we were bearish, the market was bearish because it was going lower. And if we were bears, we would have sold, gone short the market. So we've sold the market, been short the market, looking to profit from the market going lower. So being bearish or a bear. Another couple of terms we're going to take a quick look at are risk on and risk off. These are very much terms that came up and post the credit crunch, post 2007, 8, 9, post credit crunch era. We have these terms risk on and risk off. A risk on scenario usually means when traders or investors are willing to take more risk in the market, and that generally means there's a more positive outlook to either the domestic economy if it's looking at a particular economy, or for the global economy if it's looking bigger picture on a bigger macroeconomic front. So it's a positive outlook for either a domestic economy or a individual economy, or maybe for an individual stock. A risk on scenario meaning traders, investors willing to take more risk, entering to more risky assets. A risk off scenario is the converse, the opposite of that. So it's when traders or investors are less willing to take risk. So say maybe something negative is happening in either the domestic economy or the global economy, investors willing to take less risk, so they sell riskier assets and maybe buy in safe haven assets. So risk on scenario would see a move into more risky assets. That one might be like equities or shares, and a selling of safer assets, which may be bonds, or other assets like gold. What we might be seeing in a risk-off asset is investors buying gold, which is seen as a safe haven, and selling riskier assets like maybe stocks or shares. So to recap the trading terms we looked at today: to buy and to sell, to go long and to go short, to be bullish and bearish, and the terms risk on and risk off. This has been Steve Miley for The Bull, and please do join us again on thebull.com.au and thebull.asia. Stay bullish.